Exchange rate is a multifaceted phenomenon. Exchange rate could be a trade related phenomenon as per the purchasing per parity theory, as the trade flow will determine the exchange rate. So that is purchasing per parity theory. And secondly, the exchange rate could be a monetary phenomenon as per the monetary approach, as the exchange rate will be affected by the variation in demand for and supply of money in the domestic economy. Here we are going to deliberate the exchange rate as a financial asset related factor, asset related matter. So here we are going to talk about the portfolio balance model and exchange rate determination. This is asset market approach to the exchange rates and the BOPs. Welcome. So this portfolio balance approach to the BOPs and exchange rate determination is also called asset market approach, and this asset market approach to the exchange rates and BOPs is developed in the mid 1970s after the monetary approach. And as you all already aware on monetary approach, that outflow of money could happen if there is excess supply of money in the domestic economy under fixed exchange rate system. So under fixed exchange rate system, when there is excess supply of money in the domestic economy, rate of interest could decline, money will go out of the country. So outflow of money will happen when there is excess supply of money in the economy. The reverse will happen when there is excess demand for money in the domestic economy. When there is excess demand for money in the domestic economy, rate of interest could hike, and so it could attract more capital, more money into the economy. So inflow could happen if there is excess demand for money in the domestic economy, and this is the possibility under fixed exchange rate system as per the monetary approach. And as per the monetary approach itself, under flexible exchange rate system, surplus BOP's surplus of a country could be corrected through the appreciation of the domestic currency. Similarly, if there is a deficit in the BOP's account of a country, that could be corrected through the depreciation of the domestic currency. And here we are going to talk about discuss about the portfolio balance model to the exchange rate determination and BOP's adjustment. So exchange rate, equilibrium exchange rate as per the portfolio model will be determined at or when demand for financial assets is equal to supply of financial assets. So it will determine the equilibrium rate of exchange. And as per the asset market model, the individuals and businesses are the firms or companies. So individuals and the businesses hold their financial wealth in the form of domestic money, domestic bond, and foreign bond. So the people and the corporates, companies are supposed to hold their wealth in the form of either in the form of domestic money or in the form of a bond. The bond could be domestic bond and foreign bond. The foreign bond and domestic bond are not in fact the perfect substitute. Why these are not perfect substitutes? These are not perfect substitutes, as the risk involved in the investment in foreign bond is not same as the investment in domestic bond. The investment in foreign bond is a bit risky, as it is subjected to, as the invested money is subjected to the depreciation and appreciation of the currency. So the higher fluctuation in the exchange rate could affect the invested money abroad if the money is if the currency is depreciated heavily. That could badly affect the currency, the money invested in the foreign bond, as the return could come down when there is high depreciation of the domestic currency. So risk is involved in the investment in foreign bond. The demand for bond depends on a number of factors. One is yield and market rate of interest. So the return from bond, when the return from bond is high, the demand for bond will also be high. So the return here is in the form of market rate of interest. So when the market rate of interest on the concerned bond is higher, the demand for bond is higher. At the same time, when the market rate of interest offered by the domestic bond is greater than the foreign bond, then the demand for domestic bond will increase, demand for foreign bond will come down, and the reverse will happen when the foreign bonds are offering higher rate of interest than the domestic bond. So the demand for foreign bond could increase, and the demand for domestic bond could decline. Second factor driving the demand for bond is opportunity cost of the money that is going to be invested in the bond. So what is the opportunity cost of money? So opportunity cost of the money, when the opportunity cost of the money is higher, then the people are less likely to make their investment in bond. They will go, if the investor is rational, he will opt the best investment opportunity. So economization of his money is important. So the rational investors will be aware of this kind of opportunity cost always. So higher the return, then the smaller will be the demand for money, and when higher the return, higher will be the demand for the concerned financial asset. And another factor that could drive the demand for bond is the nature of investors. So investors could be of different natures. So mostly the people are supposed to be risk averse people, and for the risk averse people, there are so many hedging opportunities in the financial markets. And as far as the risk lovers are concerned, they are highly likely to make their investment in bond and other financial asset. And here let's look the equilibrium portfolio. So equilibrium portfolio is the desired portfolio, and in the portfolio, as per the basic asset market approach, here we have three type of assets. One is the demand for money itself, second one is domestic bond, and third one is financial foreign bond. And as far as an individual or a company is concerned, they do want to have a desired portfolio of their investment as per the expectations of the investors. So they could reshuffle their portfolio until they obtain a desired level of portfolio. So let's look how could the investors respond to the changes in the rate of interest, changes in domestic rate of interest under flexible exchange rate system. So suppose there is a rise in domestic rate of interest in an economy, so that could lead to increase in demand for domestic bond, and the demand for holding money will decline, and they want to invest in domestic bond as it is offering higher rate of interest. So capital inflow will happen if the rate of interest offered by the domestic bond is well higher than that of foreign bond. So investors will sell foreign bonds, and the demand for domestic currency will rise. So appreciation is the result when there is an increase in domestic rate of interest under flexible exchange rate system. So under flexible exchange rate system, when domestic rate of interest is increasing, the demand for domestic bond will increase, demand for foreign bond will decline. The investors will sell the foreign bond and they want to purchase domestic bond. So the demand for domestic currency will increase as they want to convert their currency into the domestic currency. So domestic currency's demand will increase and that could lead to the appreciation of the domestic currency. When there is rise in domestic rate of interest and it is also remaining higher than that of uh, foreign bond, foreign market, and suppose there is a rise in foreign rate of interest. So what could happen when rate of interest increases abroad? So in this case, the demand for foreign bond will increase, demand for foreign exchange will increase. Investors will sell the domestic bond as the domestic bonds are now offering less rate of interest than the foreign bond. So foreign bond is offering higher rate of interest. So people and businesses want to invest in foreign bond. The demand for foreign bond will increase. The demand for foreign exchange will also increase. So that could lead to the depreciation of the domestic currency. So depreciation could happen when there is higher rate of interest offered by the foreign bond. So this is kind of the impact under flexible exchange rate system